We're getting figures on the U.S. jobs market that indicate that it's been weak now for about 3 months, or weaker than had been thought. This comes, of course, just 2 days after the Fed left interest rates unchanged. Did the Fed get it wrong? Should it be cutting borrowing costs? Let's get more from Jeff Schulze, Head of Economic and Market Strategy at ClearBridge Investments. Jeff, great to see you. Of course, we're all experts on central banking, but should the Fed have cut? Are they leaving it too long?
Well, I don't think they should have cut just this week, but this does fully open up the door for a September rate cut. Right. If you look at this payroll, it's clear that the U.S. labor market has kicked into a lower gear. The negative revisions to the prior 2 months were negative 258,000. So that brings June's payroll print down to 14,000. May's was 19,000. And the 3-month average job creation that you've seen is only 35,000. So we're at stall speed at this point. And the risks to the full employment side of the Fed's dual mandate are very front and center, even though we haven't seen the full tariff pass through yet. So I don't think that they should have cut in July, because if you look at private payrolls, it was still pretty healthy at 83,000 last month. But ultimately, I think a September rate cut is a foregone conclusion, given the lags in monetary policy that you see when it starts to affect the economy.
Right, a foregone conclusion. You think they'll pretty well have to go in September?
Well, we're still going to get 2 CPI releases, and we're going to get one more payroll report before the September FOMC. So things can change. If you do get a pickup of job creation in the next jobs report, maybe they will forego doing a September rate cut. But again, with that 3-month average job creation at 35,000, and most of that private payroll creation was in healthcare, which is a non-cyclical sector, I think the risks of not cutting are much greater than the risks of cutting at this point. So I think that the Fed will cut and will likely see follow through in the fourth quarter.
Is there a risk of stagflation, do you think, in the U.S. market? A weak economy, but tariffs pushing up prices?
I would call it stagflation light. You haven't really seen a big pass through of the tariffs quite yet, and that makes sense. Usually that lag for tariffs is around 3 to 5 months, and I think it's going to be much more prevalent as we get to July's CPI here next week. But ultimately, even though inflation is going to move higher and likely going to get to 3 or maybe 3.2% on a year-over-year basis, I think the risks to the labor market are going to overwhelm any of those inflationary pressures, because Powell mentioned in his presser earlier this week that his base case is that tariffs are a one-time price increase. It's the same as a tax on the consumer, and whenever you have higher taxes, it really steals from growth, and it's not inflationary persistently over the long haul. So we may get a whiff of stagflation, but ultimately, looking out to next year, a lot of reasons to be positive. If we get that Fed rate cutting cycle, we get the one big beautiful bill's peak fiscal impulse, and we get visibility on tariffs, that is going to unleash some animal spirits on the corporate side with higher capex. Mm-hmm. All of these things should create stronger economic momentum.
What is your view on stocks right now? Would you tend to underweight U.S. stocks? Would you tend to underweight or overweight them?
Well, it depends on the time frame. If you're talking very tactical over the next couple of weeks to month, I think U.S. stocks are going to have some difficult trading. We've come a long way off of the lows. The stocks are overbought. You're going to see a soft patch in economic activity, and we saw it in the labor market here today. We may actually even see a negative jobs report, given the level of job creation today and the hit from tariffs as we move forward. But ultimately, any pullback that we see, we think is a longer-term buying opportunity because of those reasons I talked about just a second ago about a reacceleration of activity next year. And I think we're going to see broader earnings delivery in 2026. So I think near term, it's going to be choppy, but longer term, I think the path of least resistance is higher for U.S. equities.
What about the U.S. dollar? We have seen it bounce off its lows. It has been pressured this year by concern over growing U.S. deficits.
I think in the near term, the dollar is going to be strengthening. This has been our view for about a month. Everybody's on one side of the boat, which is short the dollar. So usually that means the Opposite will occur when that unwind happens. Also, as we get visibility on the tariff front, as tariffs were ratcheting higher, that was causing a weaker dollar. The opposite should create a stronger dollar. And then ultimately, the Fed may start its cutting cycle, which may weaken the dollar. But ultimately, I think given this confluence of factors, the dollar may remain stable over the next quarter or so. But looking out to 2026, if the Fed does do multiple rate cuts, if global growth does stabilize because of visibility on the tariff front and all the central bank rate cuts that we've seen this year, I think that creates a dynamic where the dollar will weaken in a more material fashion after taking a breather from the weakness that we saw in the first half of this year. So I think longer term, the dollar does weaken.